Today, we're talking about a timeless piece of wisdom from Warren Buffett. Price is what you pay, value is what you get. This means it's smarter to buy a stock for $50 if it's truly worth $60 or more, rather than just focusing on a low share price. When I talk about cheap stocks, I mean the value of the company, not just the number on the stock. Investing $1,000 in a $20 stock or a $200 stock gives you the same profit if both increase by the same percentage. Our goal is to find high-quality companies trading below their true worth. And today, I'm sharing 3 stocks that I believe are incredibly cheap and look ready for a breakout. Before we dive in, please hit that like button and subscribe to the channel to show your support. Let's jump into it. The current market landscape. Opportunities amidst volatility. As we move through 2025, many major companies are performing well, but finding undervalued individual stocks is getting harder. Investor sentiment remains high, with record-breaking stock purchases by retail investors almost every month. However, some market volatility is expected. Ongoing geopolitical tensions in the Middle East persist. The upcoming Federal Reserve meeting is crucial, as investors await news on interest rate cuts amidst inflation concerns and unresolved U.S.-China trade negotiations. This volatility, while challenging, also creates significant opportunities to find undervalued companies that can thrive even in uncertain times. Stock 1, Qualcomm, QCOM, an AI powerhouse at a bargain price. Our first compelling pick is Qualcomm, QCOM, a stock I've recently added to my portfolio. This company, with a market cap of $175 billion, has seen its shares rebound slightly year-to-date after a tough past year. If you're looking for an affordable way to invest in the booming artificial intelligence trend, Qualcomm is a strong candidate. Qualcomm recently bolstered its AI capabilities by acquiring AlphaWave for $2.4 billion. This move aims to accelerate its expansion into data centers, a critical area for AI growth. While traditionally known for smartphone components, a major driver for Qualcomm's future is its rapidly growing automotive division. Modern vehicles are essentially computers on wheels, and Qualcomm's automotive sales surged over 60% last year, approaching $1 billion. This segment represents a massive, long-term growth opportunity that is just beginning to unfold. From a technical perspective, Qualcomm was stuck in a downtrend for the past 12 months, consistently making lower lows. However, it recently broke through this negative trend line for the first time in a year. If the stock can hold this new higher level, it could potentially retest the $180 mark sooner rather than later, offering solid upside. In terms of valuation, analysts project Qualcomm to generate $11.85 in earnings per share, EPS, next year. This gives it a forward PE multiple of just 13.4, which is notably below its historical 5-year average of 14.5. Its EV to EBITDA at 12.4 is also at its lowest point in a decade, excluding the 2022 market crash. While analyst price targets average $179, suggesting about 12.5% upside, I believe Qualcomm's long-term growth drivers point to even greater potential. Stock 2, Merck, MRK, a pharma giant. Due for a rebound. Next up is Merck, MRK, a giant in the pharmaceutical industry with over 130 years of history. Merck dominates the market with blockbuster treatments, most notably Keytruda, a leading cancer drug generating over $25 billion annually. The company also maintains a strong pipeline in oncology, vaccines, and animal health, positioning itself for continued long-term growth. Despite its strong fundamentals and consistent profitability, Merck's stock has underperformed significantly, down 39% in the last year and nearly 20% year-to-date. This struggle is primarily due to several factors: the looming patent cliff for Keytruda in a few years, which could lead to generic competition, ongoing bipartisan efforts in Congress to lower drug prices, and reduced sales in China because of U.S.-China trade tensions. It seems as though every challenge imaginable has recently impacted Merck, many of which are beyond its direct control. This situation bears a striking resemblance to what we saw with another pharmaceutical giant, AbbVie, a few years ago. At that time, many investors were worried about AbbVie's patent expirations, but those who invested when it was undervalued were handsomely rewarded. Could Merck follow a similar path? It's a distinct possibility. Looking at Merck from a technical perspective, the stock has been in a steep downtrend over the past 12 months. The next crucial test for the stock will be around the $82.50 mark, which acts as a key resistance level. If Merck can break through this barrier and hold above it, we could see strong upward momentum pushing its price towards $95 per share, representing a good gain from its current trading level of around $80. In terms of valuation, analysts project Merck's 2025 EPS at $8.91. This translates to a forward PE multiple of just 9.1 times earnings, which is well below the company's 5-year average of 14 times. Furthermore, its EV to EBITDA ratio stands at just 8.7 times, the lowest since 2015, and significantly below its 5-year average of 15.8 times. These metrics indicate that Merck's shares are fundamentally very cheap right now. Analysts collectively have an average 12-month price target of $100 for Merck, implying a substantial 25% upside from its current levels, making it a highly compelling value play. Stock 3. Marvell Technologies, MRVL. High growth potential in AI and chips. Our third and final cheap stock pick is Marvell Technologies, MRVL, another compelling play in the booming AI and computer chip sector. This is one of my newest personal portfolio additions, and frankly, I believe it has the highest upside potential among the 3 stocks we're discussing today. Marvell, with a market cap of $59 billion, is the smallest company on our list. Its stock has plummeted a staggering 38% year-to-date. This sharp decline was fueled by concerns like the DeepSeek fiasco and broader fears of a slowdown in AI spending. The stock even fell to the mid-$40 range at one point, which is surprising given its potential. However, the crucial point is that despite these market concerns, Marvell's actual performance and management's future guidance do not reflect a slowdown. Their revenues continue to climb rapidly. In their latest earnings report, they delivered a double beat, with revenues surging an incredible 64%. Most notably, their data center growth was outstanding, increasing by 76.5% year-over-year. This segment is the core of AI computing, and Marvell is clearly executing well. From a technical perspective, Marvell recently broke through its 67R resistance area, a bullish signal. We're also seeing a bullish crossover between the 20-day and 50-day moving averages. If the $67 level holds as new support, the stock is likely headed higher, with $76 as the next resistance target. In terms of valuation, analysts expect Marvell to generate $2.80 EPS over the next 12 months. This gives it a forward PE of 24.6 times, which is below its 5-year average of 29.5 times. But the real highlight is its incredible earnings growth projection. A massive 78% this year, 28% next year, and 22% the following year. This averages to an astounding 42% annual growth. This strong growth relative to its PE results in an extremely attractive PEG ratio of just 0.59. A PEG ratio below 1 typically signals undervaluation, and 0.59 indicates you're getting a significant amount of growth for the price you're paying. Analysts project an average 12-month price target of $92 per share, implying a fantastic 34% upside from current levels. So there you have it. Qualcomm, Merck, and Marvell Technologies. 3 stocks I believe are currently absurdly cheap and perfectly poised for a significant breakout, supported by both strong fundamentals and promising technical patterns. What are your thoughts on these companies? Which one are you most excited about? Do you already own any of them? Let me know in the comments section below. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. Thanks so much for watching today's video. If you enjoyed it, please hit that like button and subscribe to the channel. Your support truly helps us grow and continue bringing you valuable content.